Management control process. This session is based on works of Robert Simon's Human Behavior, Organizational Blocks and the Levers of Control. For more information, please visit the e-learning platform. By Karim Sharf. The management control process includes means by which senior management influences behavior and guides an organization toward achieving its mission, assures that the organization is progressing satisfactorily toward that mission, assures that its mission is still the preferred one for the organization to pursue. Viewed in its totality, management control is a process. It is a series of continuous actions that advances the organization toward an end. In practice, some of the key components of the management control process are systems, but taken as a whole, management control is a process. Failure to recognize this can lead to major management control process failures, particularly when the component parts of the process do not act in concert with one another to move the enterprise toward achieving its mission. In contrast, financial, cost, and responsibility accounting are systems. They are sets of coordinated rules, principles, and practices that interact in a regular and predictable way to gather and report information. The design and implementation of an entity's management control process are guided by the entity's mission, the entity's business strategy, management's perception of the behavior required to implement that strategy, management's beliefs about human behavior, the need for a process to assure that the entity's strategy is renewed in response to changing opportunities, risks, and uncertainties. The mission is the main objective that an organization seeks to achieve and maintain. The mission in turn influences actions. The strategy is defined as the plan that an entity intends to follow to achieve its mission. Influencing behavior is the central purpose of a management control process. The desired result of the process is behavior that moves the entity toward achieving its mission. To encourage subordinates to act efficiently and effectively in carrying out the enterprise's strategy, managers must first communicate to their subordinates what is expected of them. Subordinates must understand the organization's mission and strategy as well as their own part in carrying out the strategy. Second, motivate their subordinates to carry out the organization's strategy. Third, measure and evaluate the performance of their subordinates. A well-designed and administered management control process facilitates achievement of the entity's mission. It cannot assure it. In the end, an entity's success depends on the feasibility of its mission and the soundness and execution of its strategy. The management control environment may include informal controls that influence employee behavior. Informal controls group norms and self-controls. The second component of the management control process is organizational structure and responsibilities. It consists of the way that the organization is structured and the responsibilities that are assigned to achieve the entity's mission. The third component of the management control process is information and communication. There are three information systems that play a significant role in the management control process. They are financial accounting systems, cost accounting systems, responsibility accounting systems. The fourth component of the management control process is management control systems. Within this component, there are four subsystems, collectively known as the levers of control. The four subsystems are diagnostic control systems, belief systems, boundary systems, interactive control systems. The fifth component of the management control process, incentives, includes those incentives designed to encourage behavior by managers and employees that is consistent with achieving the entity's mission. The first component, the management control environment, sets the tone for the implementation of the management control process. By words and deeds, senior managers must create and nourish an organizational culture that supports and enhances the management control process. This is a major responsibility of senior management. A key to achieving this result is to develop an organization that understands its management control process and accepts it as being both empowering and necessary. This can be achieved best if senior management implements a management control process in which there is congruence between its components and overall purpose. In addition to a company's formal management control process, the management control environment may include informal controls that influence employee behavior. Two of the more significant informal controls are group norms and self-controls. Group norms and self-controls must be taken into account by those designing, administering, and evaluating a management control process. The second component of the management control process is organizational structure and responsibilities. It consists of the way that the organization is structured and the responsibilities that are assigned to achieve the entity's mission. Major decisions in designing the organization's structure and responsibilities involve the degree to which employees below the level of senior management will be empowered to make decisions, the types of decision rights that will be delegated, the type of organizational structure best suited to facilitate these decisions. The choice of the appropriate organizational structure and assignment of responsibilities is entity-specific. It should reflect such considerations as the entity's mission, strategy, human and capital resources, markets, information capabilities, and geographic span of operations. The degree to which senior management adopts a decentralized or centralized organizational structure is both a management control process decision and a significant determinant of the nature of the 5 other components of the managerial control process. For example, in a decentralized organization, the design of the other 5 components would reflect the orientation toward decentralization. On the other hand, in a centralized organization, the design of the other 5 components would reflect the needs of a centralized structure. An important part of the organizational structure is the assignment of responsibilities to management units. Each of these units, referred to as a responsibility center, is headed by a manager who is responsible for all of its activities. A responsibility center uses inputs. It works with these resources and usually requires working capital, equipment, and other assets to do so. As a result of its work, the responsibility center produces outputs. Responsibility centers fall into one of 4 categories. Each category is defined by the nature of the manager's responsibility for the center's monetary inputs and/or outputs that are measured. The 4 categories are revenue center, cost center, profit center, investment center. The third component of the management control process is information and communication. It consists of the flow within the entity of information relevant to the management control process. The third component of the management control process is information and communication. It consists of the flow within the entity of information relevant to the management control process. In decentralized organizations, information and the communication of information play an especially important role. Employees with decision rights need information relevant to their span of control. Senior management needs information about the key performance variables of their subordinate groups and about the entity's strategic uncertainties. All levels of management need information for planning and evaluation purposes. There are 3 information systems that play a significant role in the management control process. They are financial accounting systems, cost accounting systems, responsibility accounting systems. Financial accounting systems focus on the measurement and financial consequences of the economic activities of the whole entity and its major operating segments. The 3 major financial accounting reports are the balance sheet, income statement, and statement of cash flows. Cost accounting systems are used in many organizations for a wide range of managerial decisions. These systems recognize, measure, record, and report costs and associated non-financial information related to a company's activities, products, services, processes, and functions. Cost is a measurement in monetary terms of resources used for some purpose. Responsibility accounting systems generate financial and related non-financial information about the actual and planned activities of a company's responsibility centers, i.e., its revenue, cost, profit, and investment centers. The information output of responsibility accounting systems is a major source of the information incorporated in diagnostic and interactive control systems. Beyond reporting information about a responsibility center's past performance, responsibility accounting systems provide managers with information about future plans. The term budget is applied to the planned results of cost and revenue centers. Profit center plans are referred to as profit plans. Budgets and profit plans are used almost universally in the management control process of companies having multiple responsibility centers. These plans provide a means for top management to exercise control over decentralized operations because top management can review and approve plans before they are undertaken. They also help top management evaluate the performance of responsibility center managers. Performance reports, as the name suggests, detail the actual performance of managers. Because most managers deal with only a part of a company's activities, these reports focus on the results of those activities within a manager's control. Performance reports tend to highlight results in the activities that are key to the success of the unit to which the report refers. To be useful, performance reports must also provide sufficient background details to facilitate analysis of the results. Once a budget is developed, the managers of responsibility centers are responsible for achieving the budgeted results in an efficient and effective manner. To facilitate the analysis of how well managers have performed that task, responsibility accounting systems generate reports that compare a center's actual performance to its planned performance. Any difference between actual and planned results is referred to as a variance. Responsibility accounting systems also account for transfers of resources between responsibility centers. The value assigned to a transferred product or service is referred to as its transfer price. The transfer price is a cost to the transferee and a revenue source to the transferor. The fourth component of the management control process is management control systems. Within this component, there are 4 subsystems, collectively known as the levers of control. The 4 subsystems are diagnostic control systems, belief systems, boundary systems, interactive control systems. As a group, the role of these 4 systems is to direct employee energies toward achieving the entity's mission by overcoming organizational blocks such as employee uncertainty about the organization's purpose, pressures or temptations for employees to take inappropriate or even detrimental actions, lack of organizational focus, lack of resources, lack of opportunity, or fear of risk. Take a minute and read the information of this slide. Diagnostic control systems are used by senior management to monitor key or critical performance variables. Key performance variables are the specific things that managers and employees must do well in order to help achieve the entity's mission. Another objective of diagnostic control systems is to direct the attention of managers to implementing the appropriate critical performance variables efficiently and effectively. Diagnostic control systems include such management tools as budgets, variance reports, profit plans, project reports, balanced scorecards. The common characteristic of these tools is that they are used by senior management to hold employees accountable for their actions, which are measured against metrics that reflect the appropriate key performance variables. This slide illustrates the belief systems. Take a minute and read the information of this slide. Belief systems communicate the entity's core values and mission to its employees. The goal is to remove employee uncertainty about the entity's purpose, indicate how employees are expected to manage internal and external relationships, and inspire employees to pursue new opportunities to create value for the entity. For example, consider the belief system of a retailer whose mission is to be perceived as an upscale, customer-friendly store and whose success depends heavily on customer service and repeat business. The retailer's mission could include employee behavior guidance, such as work as a team to satisfy the customer. Respect the customer. The customer is always right. Take a minute and read the information of this slide. Together, belief systems and diagnostic control systems form a powerful approach to motivating employees to be committed to the entity's mission and to adopt patterns of acceptable behavior in their work. However, they do not prevent misguided actions that an employee might perceive as beneficial but actually endanger the entity. To protect against misguided actions by employees, boundary systems must be adopted. This slide illustrates the boundary systems. Take a minute and read the information of this slide. Boundary systems identify those actions and risks that employees must avoid. While diagnostic control and belief systems point to and encourage desired actions, boundary systems dictate what employees should not do. Boundary systems come in many forms, including codes of conduct and operating guidelines. The common characteristic of these statements is that they prescribe certain types of behavior. They also indicate the punishment for acts outside the boundaries of acceptable behavior. This slide illustrates the interactive control systems. Take a minute and read the information of this slide. Interactive control systems include those control systems that senior managers use to get involved in the decisions of subordinates with the objective of learning about new strategic opportunities, risks, and uncertainties that may require a timely shift in the entity's strategy. In contrast to the periodic, management by exception diagnostic control systems with their emphasis on variances, interactive control systems are of continuing interest to senior management. It is on these interactive control systems that they focus much of their personal attention. Interactive control systems are a principal vehicle for organizational learning. Senior management can use them to pass on experience to subordinates, subordinates can use them to pass on new perspectives and information to senior management, and together the two groups can develop new knowledge that is useful for moving the entity toward achieving its mission and, if necessary, formulating a new strategy. The fifth component of the management control process, incentives, includes those incentives designed to encourage behavior by managers and employees that is consistent with achieving the entity's mission. To achieve this goal, incentives must be aligned with the entity's mission, strategy, key performance variables, and actual performance, and with employees' decision rights. Measurable and judgmental. Frequently, incentives are tied to how well an employee performs against the employee's assigned key performance targets. The assessment of the employee's performance may involve both measurable and judgmental evaluations of the employee's actual performance. The exercise of judgment may be necessary to evaluate both desirable and undesirable actions of the employee that were not captured by the quantitative performance metric. Processes require continued updating and modifying. The sixth and last component of a management control process, monitoring, performs this function. Monitoring is a senior management responsibility. Senior management's personal monitoring of the management control process can be facilitated by the internal control process. The role of the internal control process in the management of enterprises is to provide a system of checks and balances that will give senior management reasonable assurance that the enterprise is on track to achieve its mission successfully and to minimize the probability of surprises. Properly designed and managed internal control process can help an entity achieve its performance and profitability targets and prevent loss of resources. It can help ensure reliable financial reporting. And it can help ensure that the enterprise complies with laws and regulations, avoiding damage to its reputation and other consequences. In sum, it can help an entity get to where it wants to go and avoid pitfalls and surprises along the way. Internal control activities fall into two categories: administrative controls and accounting controls. Administrative controls are designed to assure management that operations are being conducted efficiently and company policies are being followed. Examples of administrative controls include operating performance reviews and the company's written procedures for dealing with vendors, customers, and regulatory authorities. Accounting controls are concerned mainly with the protection of assets and ensuring that financial records and reports are reliable and complete. Examples of accounting controls include those procedures designed to safeguard assets, to ensure the completeness and accuracy of accounting records, and to ensure the timely release of financial statements. To help ensure they have adequate and effective internal controls, many companies establish an internal audit function. Among its many tasks, an internal audit examines and evaluates the adequacy and effectiveness of the company's management control systems. The effectiveness of the internal controlled function is very dependent on the scope of its authority, internal organizational structure, degree of independence, reporting relationships, staff qualifications, and budget. The internal audit function reports to the CEO and to the audit committee, a subcommittee of the board of directors. The internal audit function's activities are reviewed by the organization's independent auditor. There are real limitations to any internal control process. An effective internal control process can help an entity achieve its objectives, but it cannot ensure its success. Furthermore, no matter how well an entity's internal control process is designed and structured, it can only provide reasonable assurance that the entity is on track to achieve its mission successfully, and the probability of surprises has been minimized. Thank you for watching.